The numbers from Escorts, the stock's lying flat, but frankly, if you look at the numbers, it was healthy progress across segments. Most of the revenue lines did well. Let's get in Bharat Madan. He joins in right now with his thoughts on how the quarter went by and how the year could look like. Remember, in a conversation about a month earlier, he did mention that with the higher basis, don't expect the same kind of run rate of growth that we've seen in the past to continue in the future as well. But Mr. Madan, thanks so much for joining in. You know, across the segments, I mean, tractor, construction equipment, railway business, as I look at the numbers, the growth seemed to be at par or better than what the street was working with. How satisfied are you with the quarter, and how does this augur for the next couple of quarters?
No, I think we are pretty happy with the way the numbers have gone really for Q4. And I think the volumes really had surprises, both on the tractor side as well as on the construction equipment side. And though there was some pressure on the margin because of the product mix which we had, because we went into more new products into the lower HP tractor segment, which actually impacted the top line as well as to some extent some margin. But I think overall, if we had to look at really the growth option, these are the segment in which we had to be present if we really want our market share to grow. So I think it's only a temporary scenario, and we think we should be able to recover some part of it going forward as we move ahead in the next 2-3 years' time. So we think the momentum should sustain now going forward too, I think in these ranges.
Are you factoring in lower raw material costs than what you experienced in Q4 in the first couple of quarters?
No, I think at this time we can't really look at low material costs because now the inflation is setting in and we're seeing the commodity price moving up. In the last 15 months, we've seen 4% commodity price going up, which we have not been able to really fully recover from the market as of now. There's still a lag of 1%, which we need to pass it on to market. But I think that pressure will continue, so steel prices are continuing to move up. So I think the first half we expect the pressure will be there, and producing in second half, I think the things will get stabilization will start happening. And we should be able to really recover the entire thing during the course of the year.
Okay, so operating leverage, maybe some more cost control. I see, of course, that you've took up a small price hike in April as well. And I remember you talking about that as well. Maybe there 1 or 2 price hikes could come about. Is this it, or in the very near future, do you expect some more price hikes coming in from you and maybe from some of your peers as well?
No, so I think we pass on the price increases to the market with a lag of a quarter. So obviously this will depend on how the quarter goes. So obviously if this quarter also you see the major inflation coming in, which is actually looking at numbers is likely. So then there will be further price increase which will happen in the next quarter. But obviously it's more will depend on how the commodity price movement happened during the year.
And you reckon that the market share which improved a little bit, the tractor market share which improved a little bit, FY18 over FY17, let me put it that way, is there a meaningful chance of those numbers moving up substantially in FY19 as well?
Absolutely. I think that's what we have the plan really internally also. We are working on that. So if you really look at the Q4 market share, which was roughly at 13.5%, which is significantly up from last year's number of 12.4%. So I think we were looking at since the new product introduction happened in Q4. So we think that would be the more real, I think the benchmark to look at what we exited the year with. So we are working for a market share of about 12 to 20% in FY19 too.
Okay, Mr. Madan, just one question. Actually, I'm drawing this clock back to the operational numbers. I heard you mention that the raw material costs is difficult to predict. If at all, it's only going up. You've had a drop in staff costs on a quarter-on-quarter basis in Q4 already. Would operating leverage, and you don't have a handle on whether or not the kind of price hikes or what kind of price hikes will come in. So how would the margins look better than where they are right now? Would operating leverage be the one, or are there some other levers that you would probably use in order to improve or maintain margins?
No, so I think it will be a combination of both. So I think the cost initiative also, whatever company has been working on for the last few years, so on the material cost front as well as manpower cost front, right? These two continue to be our focus areas for this year too. So definitely there will be some benefit which we are looking at which will happen from these two initiatives. And that's why we are predicting 100 basis points, which we think is a safer margin guidance for next year. Looking at the way I think the product mix is turning out to be and the inflation which is setting in. And obviously, if the commodity price stabilizes, then probably you can look at even better margin. But the chances of that happening this year looks really difficult the way the industry is performing. So that's why I think we are pretty safe. So this will be a combination of both operating leverage as well as cost initiative on us, which will improve the margin further.
I think on the call you've highlighted that while the domestic tractor industry would grow 9 to 11%, you would outperform the industry. Would you want to lay out some numbers, some in-house estimates that you would have or internal targets that you may have?
Well, I think I'll not really say target, but if you look at last 2 years in FY17, the industry had grown by about 18% and we had grown 24%. So last year also the industry growth has been about 22% and Escorts had grown 26%. So I think if the industry this year too grows 9 to 11%, definitely we intend to really surpass that number. So there'll be definitely some market share improvement which is bound to happen, especially with this new product introduction which is coming in the lower HP range. So yes, I think it's somewhere around 12% plus should be the number we are looking at really in this year.
Interesting. Two questions roll into one, Mr. Madan, before we wrap up. One, exports market, what's the growth target and if you plan to add any new geographies? And two, combined with that is the railways business. What's the order book you're sitting on? And can we expect about a 20% plus growth target for FY19 in the railways business?
Well, I answered the railway first. So definitely the order book is about 350 crores as of end of March. And that will be getting executed within the next 12 to 30 months. So with that sort of number, definitely we can expect 20% sort of growth in railway business easily for this year. On the export market, we are looking at opening the market. So like you said, we are decided to go into 5 or 6 hubs internationally where we'll be operating from. It's starting from the hub of North America and Mexico, I think where the major market lies. Then Latin America, Brazil is the second base which we have. Then in Africa is the third base. And then in Europe, we got 2 bases, one in the Eastern Europe side, where we got our own subsidiary in Poland, and on the Western Europe side in the Northern African market, Delhi, India, Turkey, Algeria, etc., which are the main hubs for the tractor industry. And the other hub will be on the Southeast Asia side. So they're all neighboring South countries as well as in the countries like Myanmar, Cambodia, Thailand, so which will be again focus area. So these 5 or 6 hubs we are going to be there where we expect our business to really grow in the nearby markets. And like I said, the plan is to take these export numbers to 8 to 10,000 tractors by 2022. So we hope the kind of investment we are doing on the international portfolio build-up, that will happen too soon.